Real estate or stocks? Which one actually builds more wealth for the average lazy investor in 2025? You hear it everywhere. Real estate gurus push buy rentals and get rich with cash flow. Stock market fans say just buy index funds and chill. Both sides claim they're right, but when you look at the data for truly passive, lazy investing, one comes out way ahead for most people. Let's compare them fairly, apples to apples, with real numbers and no hype. First, the lazy stock approach. Low-cost broad market index funds like VTI, Total U.S. Market, or VOO, S&P 500. Historical average total return, about 10% annually over the last 50-plus years, including dividends reinvested, Vanguard and S&P Dow Jones data through November 2025. If you put in $500 a month at a 10% average return, after 20 years, you will have accumulated $383,000. After 30 years, that figure has now grown to $1,130,000. After 40 years, you're looking at a whopping $3,180,000. Effort level. Set up automatic contributions once, never look again. No tenants, no repairs, no property managers eating your profits. Now, real estate, the classic single-family rental. Average U.S. single-family rental net return after all expenses, mortgage, taxes, insurance, maintenance, vacancies, management, 5 to 8%, according to the National Association of Realtors, Roofstock, and BiggerPockets 2025 reports. That includes cash flow plus appreciation. To make it comparable, let's use a realistic example. Take a $400,000 property with 20% down, $80,000 at a 4.5% mortgage, 2025 average rates. If monthly rent is $2,200, after mortgage, taxes, insurance, 8% vacancy, repairs, and 10% management fee, net cash flow is $600 to $800 per month. Appreciation around 3 to 4% annually, long-term Case-Shiller average. After 30 years, assuming 3% rent and appreciation growth, total equity plus cash flow reinvested, roughly $1.2 to $1.8 million, NYU Stern rental calculator and historical data. Sounds good, but subtract the headaches. Tenant turnover, emergency repairs, eviction costs, property tax hikes, insurance jumps, and illiquidity. Selling takes months and 5 to 10% in fees. For truly lazy real estate, you'd use a real estate investment trust like VNQ, Vanguard Real Estate ETF. Historical return of 9% annually, almost stock level but with stock-like ease and diversification. 3 big reasons stocks beat direct real estate for lazy investors. True passivity. No 2 a.m. calls about broken toilets. Real estate is a second job for most landlords. Liquidity and diversification. Sell stocks instantly. One property is concentrated risk. Location, tenant, market crash. Taxes and fees. Stocks in a Roth IRA grow tax-free. Real estate has property taxes forever, depreciation recapture, and capital gains on sale. A 2025 Vanguard study comparing asset allocations found 100% stock portfolios outperformed real estate-heavy ones for most 30-plus year periods after accounting for fees, taxes, and maintenance. Real estate can absolutely build wealth, especially if you love it, live in a hot market, or use leverage perfectly. But for the average person who wants to invest and forget, stocks are simpler, more profitable, and far lazier. Click my Robinhood referral link in the description below and get started in trading stocks now. Robinhood will give you a free stock with my link just for signing up. Like if stocks just won for you. Comment real estate or stocks. Let the debate begin. Subscribe for more no BS comparisons. Thanks for watching. Now go be lazy and get rich.